A company reports profit growth of more than 9%. Earnings per share beat what analysts expected. Revenue climbs 13% from a year earlier. By almost any ordinary business standard, that is a good quarter. And within hours of releasing those numbers, the stock collapsed more than 8% in after-hours trading, adding to a decline that had already erased over 40% of the company's value from its peak earlier in the year. This was Netflix on a Thursday evening in July, and the reaction tells a story far bigger than one earnings call. It is a story about what happens when a business built its entire reputation on acceleration and then, for the first time in years, simply grows a little more slowly than it used to. Nothing about the company broke, nothing failed, and yet the market's verdict was unmistakable. Slower is dangerous, even when slower still means healthy, profitable, double-digit growth that almost any company on Earth would celebrate. To understand why this happens, it helps to separate two very different questions that sound similar but are not. Is a company growing? And is a company's growth speeding up or slowing down? Investors in high-growth companies are rarely satisfied by growth alone. They are pricing in a trajectory, a curve bending upward at an accelerating rate, because that acceleration is what justifies paying a premium price today for profits that are still mostly theoretical, still sitting years in the future. When that curve bends the other way, even gently, even while remaining firmly positive, the entire premise behind the premium starts to wobble. Netflix's growth rate slid from 16% in the first quarter to just over 13% in the second, with guidance pointing towards something closer to 12% in the quarter ahead. Each of those numbers, examined alone, describes a thriving business. Examined together as a sequence, they describe deceleration, and deceleration is the one signal that growth investors are trained to treat as a warning, regardless of how strong the absolute numbers still look sitting next to it.
What makes this particular sell-off even more revealing is that the market had already been punishing Netflix for months before this report ever arrived. The stock had fallen roughly 40% from its high point earlier in the year, well before any single earnings call confirmed a slowdown was actually happening. This is one of the more unsettling truths about how markets process information. Prices often move ahead of official confirmation, absorbing rumors, competitor data, sentiment shifts, and subtle behavioral signals long before a company's own quarterly report makes anything official. By the time Thursday's numbers landed, a large portion of the bad news had, in a sense, already been lived through by shareholders in slow motion over the preceding months. The earnings call didn't create the crisis. It confirmed a story the market had already started writing on its own, which is precisely why a report that beats several individual estimates could still trigger another leg down. Confirmation of a fear, even a fear that turns out to be milder than expected, still closes the door on the hope that the fear might have been wrong. Beneath the numbers sits a competitive threat that barely existed in the form it takes today when this company first became a dominant force in entertainment. Netflix's most serious challenge is no longer another streaming service with a similar library of shows and films. It is platforms built around videos lasting 60 seconds instead of 60 minutes, an entirely different category of entertainment competing for the exact same finite resource, a person's evening attention. This is a difficult kind of competition to fight because it doesn't announce itself with a rival subscription price or a marketing campaign. It simply quietly absorbs minutes that used to belong to long-form viewing, one scroll at a time across an audience that increasingly treats short bursts of content as the default way to unwind. A company can be the undisputed best in its own traditional category and still be losing a larger, less visible war over how people choose to spend their limited free time each day. And that second battle is far harder to measure, harder to respond to, and ultimately far more dangerous than any competitor offering a similar product on a similar screen.
Strategic missteps compound these pressures in ways that rarely show up cleanly in a single quarter's numbers, but shape investor confidence for years afterward. Earlier this year, Netflix pursued a major acquisition of a legacy studio and its streaming assets, a deal that would have added scale, a deep film library, and significant leverage in future licensing negotiations. That deal ultimately went to a rival bidder instead. Losing a major acquisition battle is rarely fatal on its own, but it forces a public reassessment of a company's competitive position at exactly the moment investors are already nervous about growth. It raises an uncomfortable question that lingers well beyond the immediate transaction. If this company cannot secure the assets it wants through acquisition, how exactly does it plan to keep expanding once its organic growth engine, new subscribers and new markets, eventually runs its natural course? Markets do not need an acquisition to fail to punish a company for losing one. The mere loss itself becomes evidence in a broader argument about whether management still has enough strategic options left to keep the growth story alive. In the middle of all this pressure, the company made a decision that added a layer of uncertainty rather than reducing it. It announced it would share detailed engagement and viewership data with investors less frequently going forward. Management framed this as an effort to redirect attention toward revenue and profit, rather than getting caught up in individual show performance. Investors, understandably, read it differently. Reducing transparency during a period when confidence is already fragile tends to invite the exact suspicion it claims to be avoiding. When a company shares more information, it signals a kind of confidence, an implicit statement that current performance can withstand scrutiny. When a company shares less information, especially right as growth begins to slow, the market naturally starts filling in that silence with its own assumptions, and those assumptions tend to skew toward the worst-case explanation rather than the most charitable one. This is a lesson that extends well beyond any single company. In moments of uncertainty, withholding information rarely buys goodwill. It tends to spend whatever goodwill still remains.
None of this is entirely unfamiliar territory for this particular business, and its own history offers a genuinely useful counterpoint to the current anxiety. Several years earlier, this same company faced a much sharper crisis, losing subscribers outright for the first time in a decade, watching its stock fall by more than half within months. At the time, many treated that collapse as proof the company's best years were permanently behind it. Instead, management responded with two unpopular but disciplined decisions: introducing a lower-cost, advertising-supported tier and cracking down on the widespread practice of sharing account passwords across households that had never paid for their own subscription. Both moves were criticized loudly in the moment. Both moves ultimately reignited growth and opened entirely new revenue streams that hadn't existed before. This history matters enormously for how today's slowdown should be interpreted. It does not guarantee a repeat performance, but it does establish that this particular management team has already demonstrated, under real pressure, an ability to rebuild a growth story rather than simply manage its decline, which is a meaningfully different track record than a company facing its first real test. There is also a deeper, more structural force at work here, one that eventually confronts every business built on rapid subscriber or user growth. No addressable market is infinite. At some point, a company selling a subscription to a limited pool of potential customers runs out of new customers to add, simply because most of the people who wanted the product already have it. When that point arrives, the entire nature of the growth challenge shifts from acquiring new customers to extracting more value from the customers already onboarded through price increases, new advertising products, bundled offerings, or entirely new categories of content and service. This transition period is almost always uncomfortable for investors because the clean, easily understood story of adding millions of new subscribers every quarter gets replaced by a messier, harder to forecast story involving pricing power, engagement depth,
and monetization efficiency. Markets have historically struggled to value companies fairly during exactly this kind of transition, often overreacting to the loss of the simple story before the more complex replacement story has had enough time to prove itself.
This transition also forces a repricing that tends to be far more violent than most investors expect going in. A stock priced as a growth story carries assumptions about the distant future baked directly into today's valuation. And when the market begins to suspect that story no longer applies, it doesn't gently nudge the price down to reflect a slightly slower growth rate. It often reprices the entire business as though it belongs in a completely different category altogether, one valued more like a mature, steady, cash-generating enterprise than a company still expanding at a breakneck pace. That kind of re-rating can happen extremely fast, compressed into a matter of months rather than years, precisely because so much of a growth stock's value depends on maintaining a specific narrative rather than reflecting the calm, steady arithmetic of current earnings. Watching a stock lose 40% of its value while its underlying business remains genuinely profitable is not really a story about the business collapsing. It is a story about a market violently renegotiating which story it believes it is paying for. For anyone holding shares through a period like this, the more important discipline has nothing to do with predicting the next quarter's numbers and everything to do with separating two very different questions that panic tends to blur together. The first question is whether the original reasons for owning the business still hold, whether its competitive position, its content pipeline, its ability to monetize its audience remain intact despite a slower growth rate. The second, entirely different question is simply how the stock has moved recently. Price movement alone tells an investor almost nothing about whether the underlying thesis has actually changed. Yet it is the single loudest, most emotionally persuasive piece of information available in any given moment. Selling purely because a stock has fallen sharply, without reassessing whether the business itself has genuinely deteriorated, is one of the most common and costly mistakes ordinary investors make, precisely because a falling price manufactures a feeling of urgency that has little relationship to whether the original investment case still makes sense.
Step back far enough, and this entire episode points towards something larger than one company's earnings report. In an economy where information and entertainment are available in nearly unlimited supply, the truly scarce resource has quietly become something much simpler: a person's finite attention. Every platform, every app, every streaming service, every short-form video feed is ultimately competing for the same fixed number of hours in a single day, a currency that cannot be printed, borrowed, or expanded no matter how much capital gets thrown at the problem. Businesses that once competed narrowly against a handful of direct rivals now find themselves competing against an almost limitless field of alternatives, all fighting for the same evening, the same commute, the same idle 15 minutes between tasks. Understanding this shift matters for investors far beyond any single media company, because it reframes what a durable competitive advantage actually looks like going forward. The winners of the next decade will not simply be companies with the best content or the lowest price. They will be the ones that most successfully earn and hold on to a portion of humanity's most limited, most fiercely contested resource. What happened this week is a reminder that markets rarely punish companies for failing outright. Far more often, they punish the loss of a story, the quiet moment when a business that once seemed destined for endless acceleration reveals itself to be merely very good instead of unstoppable. That distinction sounds small. In practice, it can move tens of billions of dollars of value in a single evening. The companies and investors who navigate this kind of moment well are rarely the ones who guessed correctly about a single earnings report. They are the ones who understood, long before the report ever arrived, that no growth curve bends upward forever, that every dominant business eventually has to prove it can evolve rather than simply expand, and that the true measure of a company's strength is not how the market reacts to one difficult quarter, but how it responds in the years that quietly follow it.